You know, um, when you think about achieving a massive goal, I mean, the human brain almost always focuses entirely on the climb.
Oh, absolutely. Yeah.
Like, accumulation is basically like climbing Mount Everest. It's exhausting, and it takes years of discipline, but the goal is brilliantly clear. You just keep stepping up.
Right, the upward trajectory. You maximize your contributions. You tolerate the market volatility. You defer your taxes.
Exactly. Up, up, up. But here's the thing about Everest. Most of the fatal mistakes, they don't actually happen on the way up.
No, they happen on the descent.
Yeah, exactly.
Yeah.
Distribution. So coming down the mountain, it requires entirely different equipment.
Yeah.
And yet people constantly try to use their climbing gear for the way down.
Because it's what they know. I mean, the descent requires a completely different physiological and psychological approach, and, the financial equivalent is just as jarring.
Right?
We spend 30 or 40 years conditioned by the rules of accumulation. We're told to buy and hold, reinvest dividends, ignore market crashes.
To write it out.
Right. But then, overnight, you transition out of the workforce, and those exact same instincts actually become your biggest vulnerability.
Which brings us to the mission of today's deep dive. We are unpacking a pretty counterintuitive reality for high net worth individuals. The very skills you use to build your wealth can actively work against you when it's time to spend it.
Yeah, it's a huge blind spot.
So if you're tuning in today, especially if you're the learner out there, someone constantly looking to master the mechanics behind the curtain rather than just skimming the surface, this one is custom tailored for you. We are analyzing a comprehensive distribution framework authored by Thomas Davies of Davies Wealth Management.
Out of Stuart, Florida, right?
Right, Stuart, Florida. They are a fee-based fiduciary advisory firm, and they frequently explore these high net worth pressure points on things like the 1715 Treasure Coast Financial Wellness podcast.
And the context of who this framework is built for is vital. Standard mass market retirement advice relies heavily on Social Security to form a massive bedrock of retirement income.
Right, for the average person.
Exactly. But for a corporate executive or a successful business owner who peaked at, say, $500,000 or more in annual salary, Social Security is mathematically insignificant.
Right, it's a drop in the bucket.
It really is. It might replace 5 to 10% of their pre-retirement income. So that means the entire burden of cash flow generation falls squarely on the investment portfolio. The portfolio literally becomes the paycheck.
Okay, I want to challenge this premise right out of the gate, though, because I think a lot of people who have been highly successful at accumulating wealth might look at this and wonder, well, why does it have to be so complicated?
Sure.
Like, if someone grew their portfolio to, let's say, $4 million over a 25-year career, why can't they just easily pull out $200,000 a year? Doesn't a massive pile of capital naturally just sustain itself? I mean, if you have $4 million, it feels like you should just be done.
You would think so, but the assumption that a large balance automatically equals sustainable income is actually the most common pitfall in executive wealth management.
Really?
Yeah. During the accumulation phase, if there's a severe market dip on your $4 million portfolio, it doesn't impact your daily life because your salary covers your mortgage and your groceries.
Right, you just ignore the statement.
Exactly. You can afford to just wait for the market to recover. But in the distribution phase, that $4 million isn't a static monolith. If you are blindly liquidating assets to generate that $200,000 and you happen to sell equities during a 20% market correction, you are realizing those losses permanently.
Oh, wow.
Yeah, you are doing structural damage to the principal that compound interest simply cannot repair fast enough.
Okay, let's unpack this. Because if we aren't just looking at one big $4 million pie that we slice from randomly, we need a mechanism to separate the money we need tomorrow from the money we need in 20 years.
Precisely.
I'm visualizing this like a cascading water filtration system.
Oh, I like that.
Yeah, so you have the raw, turbulent river water at the top. That is your equity market, right? Highly volatile, fast-moving. You wouldn't want to drink that during a storm.
No, definitely not.
But you let that filter down into a middle holding tank, and then finally it flows into the calm, ready-to-drink tap water at the bottom. So if there's a severe drought or a market crash, you never go thirsty because you already have a purified supply sitting right there in the tank.
The mechanics of that analogy map perfectly onto the time segmentation strategy Davies Wealth Management advocates. Large portfolios need a deliberate architecture.
Okay.
So that ready-to-drink tap water, that is your immediate liquidity. This covers the first 2 years of your retirement expenses.
2 years, okay.
Yes. We are talking purely cash, money markets, and short-term bonds. The yield on this capital is intentionally secondary. Its primary function is just
So
insulation.
not growth.
No, not at all. By securing 24 months of living expenses, you guarantee that if the market crashes tomorrow, you will not have to liquidate a single share of equity at a loss to fund your lifestyle.
So it buys you the psychological permission to leave the rest of your portfolio alone during a crisis.
Exactly.
But obviously that 2-year supply eventually runs dry, right?
It does, which brings in your middle filtration tank. This covers years 2 through 10 of your retirement.
Yeah.
You fund this with intermediate duration bonds, dividend-producing equities, and income-generating alternatives. It takes on slightly more duration and market risk than your cash reserves, but it generates the steady, reliable yield necessary to constantly refill your liquidity tank over time. It acts as a buffer.
And that leaves the turbulent river water for the long term.
Exactly right. The final component is your growth capital. This is money you know for a fact you will not need to touch for at least 10 years.
Because it's so far out.
Right. Because the time horizon is so long, this segment can handle the volatility of the equity markets and real assets. Its entire job is to aggressively outpace inflation and preserve your purchasing power over a 3-decade retirement.
But to make this cascading system actually function, you can't just treat every dollar flowing out of the tap equally, right?
No, you can't.
Because if we look at the source material, a major part of this architecture is categorizing the outflow. High net worth retirees generally have 3 distinct layers of spending.
Yeah, the tiers.
Right. You have the essential tier, so housing, healthcare, the non-negotiables. Then the lifestyle tier, which is the European vacations, the country club dues, and finally the legacy or discretionary tier.
Defining those tiers dictates the pressure on your portfolio. If a severe recession hits, a dynamically managed plan doesn't just keep draining the tanks at the same rate.
You tighten a belt.
You intentionally compress the lifestyle tier, you delay the kitchen remodel, or you skip the international trip for 1 year, relying entirely on your cash buffer for essentials. That allows your equity segment time to recover.
So we've built the plumbing.
Yeah.
The cash flow is insulated from market volatility, but insulating the principal from market crashes is only half the battle.
Right.
Because the other immediate threat to that money is the IRS. And reading through the framework, standard generic tax advice actually looks incredibly dangerous for an executive with millions in deferred compensation.
Oh, it is. The default advice you read online usually dictates a very simple withdrawal order. They say, spend your taxable brokerage money first, let your pre-tax 401k or traditional IRA defer for as long as legally possible so it keeps growing, and never touch your tax-free Roth accounts until you absolutely have to.
Right, which sounds logical on the surface, defer the tax paying as long as possible.
It sounds logical until you understand the underlying motivation of the tax code. The government allows pre-tax deferrals because they eventually want to collect tax revenue on a much larger number.
Oh, right.
If an executive has $3 million sitting in a pre-tax 401k and leaves it completely untouched, that balance might double by the time they hit the age for required minimum distributions, or RMDs, which is currently 73.
At which point the IRS forces you to start taking money out, whether you want to or not.
Precisely. And because the balance has grown so massively, the forced RMD could easily be a mandatory 6-figure withdrawal every single year.
Oh, man.
And every dollar of that withdrawal is taxed as ordinary income. So the retiree is inadvertently pushed into the highest possible tax bracket, losing a massive percentage of their wealth to the government simply because they waited.
They create what the industry calls a tax torpedo.
Yes. The tax torpedo.
So to diffuse that torpedo, instead of waiting for the IRS to force a massive withdrawal at age 73, a strategic approach would be preemptively pulling money out in your 60s.
Exactly.
You voluntarily pay the tax now at a known lower rate to shrink that pre-tax bubble before it explodes.
We call that intentional bracket filling. When a highly compensated executive retires at, say, 62, their earned income suddenly drops to 0. But their RMDs don't start until 73.
So there's a gap.
Right. They have an 11-year window where they are in a temporarily low tax bracket. A fiduciary will use this window to execute surgical Roth conversion.
Okay, surgical how?
Well, you might intentionally move $150,000 to $250,000 from the traditional IRA to a Roth every single year. You pay the tax out of pocket now, filling up the 24% or 32% bracket so that the money grows tax-free forever in the Roth.
Completely eliminating the future RMD burden on those dollars.
Exactly.
Here's where it gets really interesting, though. Because as I was studying this bracket filling strategy, I ran into the section on IRMAA. And I realized this isn't just a basic optimization game with the IRS. It is highly reactive, and it operates on a hidden time delay.
Oh, yeah. IRMNA is the income-related monthly adjustment amount. It is essentially a stealth tax.
Right. It's a surcharge on your Medicare Part B and Part D premiums if your modified adjusted gross income crosses specific thresholds.
Yeah.
But the trap is the look-back period, right? IRAA determines your surcharge based on your income from 2 years prior. So if I'm understanding this correctly, if I execute a brilliant Roth conversion today at age 63 to save on future income taxes, I could unknowingly trip an IRAA threshold that causes my Medicare premiums to skyrocket 24 months later.
That is the exact hazard, and it catches self-directed investors constantly. IRMAA thresholds act as cliffs, not marginal brackets.
Wow, cliffs.
If you go one single dollar over an IRMAA threshold, your Medicare premiums for the entire year can increase by thousands of dollars. You thought you were optimizing your tax bracket, but you inadvertently triggered a massive... Here's why distribution planning cannot be done in a single-year vacuum. Every financial move ripples forward.
Which naturally leads us to the broader mathematical risks of timing. We touched on market crashes earlier with the bucket strategy, but we need to put some hard numbers to what actually happens when timing works against you. The concept of sequence of returns risk.
Sequence of returns risk explains why average annualized returns are a deeply flawed metric in retirement.
Okay, how so?
Let's look at two identical retirees, both starting with a $3 million portfolio and both needing $200,000 a year to live. If retiree A experiences a severe 25% market crash in year 20 of their retirement, it's unfortunate, but they have a smaller time horizon left and their spending needs might have naturally decreased.
Right, the principal damage is contained.
But if retiree B takes that exact same 25% drop in year 1 of retirement,
Ouch.
yeah, their $3 million instantly becomes $2.25 million. And because they still need their $200,000 living expense that year, they are pulling it from the depleted $2.25 million base.
They are locking in the losses.
They are locking them in. Even if the market roars back the following year, the portfolio is rebounding on a significantly impaired foundation. The math simply breaks. The money could run out decades earlier than projected, purely because of the sequence of the market returns, not the average of the returns. So how do you practically defend against a bad sequence? Because you obviously cannot control whether the stock market crashes the week after your retirement party.
No, you can't. You defend against it through dynamic withdrawal mechanics and rigorous stress testing. Instead of blindly pulling a fixed percentage every year, regardless of reality, a sophisticated plan reacts to the environment.
This goes back to our spending tiers.
Exactly. If the market is down 20%, you slash the discretionary outflow. You rely solely on your liquidity bucket. But more importantly, you anticipate this before retirement using Monte Carlo simulations.
Meaning you aren't just projecting a straight 6% return every year on a spreadsheet. You're running thousands of randomized, simulated market sequences to see if the plan survives the worst-case historical scenarios.
Precisely. A Monte Carlo analysis will tell you your probability of success across thousands of chaotic timelines. If your retirement plan only succeeds when the market performs at or above average, you do not have a robust distribution plan.
You're just relying on luck.
You are just relying on luck. And what happens if the plan works perfectly? Because for a high net worth portfolio, say $5, $10, or $20 million, the reality is that the wealth is designed to outlast the retiree.
Yes, it is.
Every dollar you choose to spend today, and which specific account you pull it from, directly dictates exactly what your heirs receive tomorrow and what the IRS will take from them. Estate planning seems deeply embedded in the withdrawal strategy.
You absolutely cannot separate income distribution from estate planning. The sequence of your depletion dictates their legacy, and the environment governing this has recently settled into a new reality.
Right.
The source framework highlights the One Big Beautiful Bill Act from July 2025, which finalized the elevated federal estate and gift tax exemptions. We are now operating with permanent exemptions of $15 million per individual and $30 million per married couple, indexed for inflation.
So a married couple can pass down $30 million before federal estate taxes even begin to apply. That offers massive relief from a wealth transfer perspective.
It provides immense clarity, yes. Though families still must navigate state-level estate taxes, which often trigger at dramatically lower thresholds. But the real hidden danger for the next generation isn't the estate tax at all.
It's the income tax.
It is the income tax embedded in the specific accounts they inherit.
This was the part of the guide that really reframed how I view account types. If we go back to the basic buckets, say I leave my daughter a traditional IRA versus a Roth IRA versus a standard after-tax brokerage account. The outcome for her is wildly different for each.
Completely different, and this again ties back to why the government structures the rules the way they do. If you leave an inherited traditional IRA, your heirs are subject to the 10-year rule.
The 10-year rule.
Right. The government wants that deferred tax revenue, so they mandate that the beneficiary must empty the entire inherited account within 10 years of your passing. Because it is pre-tax money, every single dollar withdrawn counts as ordinary income.
So if I leave a $2 million pre-tax IRA to my daughter, right when she is in her peak earning years, maybe her early 50s, she is likely already in a high tax bracket.
Yes.
This inheritance forces her to take massive taxable distributions on top of her salary, pushing her into the highest possible marginal rates. It is like handing someone a beautiful gift box that's actually filled with IOUs to the IRS.
That is exactly the reality. It becomes an administrative and tax burden. Now, contrast that with passing down a Roth IRA. The Roth also carries a 10-year emptying rule under current law, but because the taxes were paid up front, every single qualified withdrawal the heir makes is completely tax-free.
No, nice.
They get the growth and the distribution without altering their own tax bracket.
And what about the standard taxable brokerage account, like the after-tax money that's been growing for decades?
The taxable brokerage account is often the absolute best asset to hold until death, primarily because of a mechanism called the step-up in basis.
Step up in basis, okay.
Let's say you bought a block of stock for $10 a share, and over your lifetime it grows to $100 a share. If you sell it while you are alive, you owe capital gains tax on that $90 of growth.
Right.
But if you hold it until death, your heirs inherit that stock with a new cost basis of $100. The $90 of lifetime capital gains growth is wiped out entirely from a tax perspective.
Wait, entirely?
Entirely. They could liquidate the stock the very next day and owe zero federal capital gains tax.
Yeah. So if I am in my late 70s and I need cash for living expenses, it might mathematically make sense for me to spend down my own traditional IRA, pay the ordinary income taxes myself while I am in a controlled bracket, and intentionally preserve the taxable brokerage accounts so my kids get that massive step up in basis.
That is the essence of multi-generational tax optimization. You are systematically shifting the tax burden to the entity and
And what if the entity you want to benefit isn't your heirs, but a charity? The source outlines a couple of very specific, heavy-hitting tools for executives who are charitably inclined and how that integrates with distribution.
There are two highly effective mechanisms for this. First is the qualified charitable distribution, or QCD. Once an individual reaches age 70 and a half, the IRS allows them to transfer up to $105,000 per year directly from their IRA to a qualified charity.
Okay, so it goes straight to the charity.
Right. And the strategic advantage here is that this transfer satisfies your required minimum distribution, but the money never touches your adjusted gross income.
Meaning it doesn't inflate your tax bracket, and it doesn't trigger that 2-year IRMAO Medicare trap we talked about earlier.
Exactly. It bypasses the tax return entirely while fulfilling the government's distribution mandate.
That's brilliant.
It is. And the second mechanism is highly relevant for corporate executives. The Charitable Remainder Trust, or CRT.
CRT.
Executives frequently retire with highly concentrated equity. Perhaps they spent 20 years at a publicly traded tech firm and have millions locked up in a single company's stock.
Which is risky.
Very risky. But selling it outright would trigger a devastating capital gains tax event.
So instead of selling it, they use the trust.
They transfer the highly appreciated stock into the Charitable Remainder Trust. Because the trust is tax exempt, it can sell the concentrated stock and instantly diversify the portfolio without generating any immediate capital gains tax.
Oh, wow.
The trust then pays the executive a steady income stream for the rest of their life. When the executive passes away, whatever principal remains in the trust goes to the designated charity.
So everybody wins.
It solves a dangerous portfolio concentration risk, generates reliable retirement income, and provides an immediate charitable income tax deduction upon funding.
It really highlights the sheer volume of complex mechanics running under the hood here. Which brings us to the final necessity. Building a living, adaptive income plan. You can't just set up your 3 cascading buckets, Run a Monte Carlo simulation on a Tuesday and then walk away for 30 years?
No. An architecture built in year one cannot remain static because the macroeconomic environment and your personal circumstances are in constant flux. The Davies framework emphasizes the absolute necessity of rigorous annual checkpoints.
Right, because things like those, required minimum distributions, recalculate every single December 31st based on the new account balance.
Exactly. If the market experiences a massive bull run, your portfolio balance inflates. That means your mandatory RMD the following year will be significantly higher, which could spike your taxable income and trigger an IRMA surcharge that you weren't anticipating.
So you have to constantly adjust the sales.
You do. Furthermore, spending patterns naturally evolve. A retiree might travel extensively in their 60s and 70s, drawing heavily from the lifestyle tier, but travel less in their 80s as healthcare and longevity costs begin to dominate the essential tier.
This underscores a major distinction made in the guide regarding the type of professional you rely on. They draw a hard line between working with a fiduciary advisor versus a product-selling broker. Given everything we've discussed about distribution, why is that distinction so critical for this specific phase of life?
It comes down to structural alignment and ongoing responsibility. A traditional broker is often compensated by executing a transaction or selling a financial product, a mutual fund, an annuity, a proprietary vehicle.
Right, they make the sale and move on.
Exactly. Once the product is sold, the engagement is largely fulfilled. But distribution planning is an ongoing, multi-decade process of tax sequencing, bracket management, and dynamic cash flow adjustment.
So you need a different kind of partner.
You do. A fiduciary is legally obligated to act in your best financial interest at all times when providing investment advice, and they are typically compensated by a transparent, fee-based structure rather than hidden commissions. You don't need someone to sell you a single piece of climbing gear. You need someone managing the entire chessboard year after year.
And timing is everything on that chessboard. The source explicitly warns that the most catastrophic mistake an executive can make is waiting until the week they retire to figure this out.
Waiting until retirement day is the equivalent of trying to pack your parachute after you have already jumped out of the aircraft.
Ouch.
The transition from accumulation to distribution should begin 3 to 5 years before you actually leave the workforce.
3 to 5 years.
That runway is critical. It gives you the necessary time to manage the complex timing of deferred compensation payouts, structure early Roth conversions while you have control over your earned income, and methodically shift the portfolio into the 3-bucket structure without taking massive tax hits all at once.
So what does this all mean for our listener? If I'm synthesizing the big picture here, the accumulation phase of life, building the wealth, was largely an exercise in brute force.
Yes.
It was about patience, maximizing contributions, and just letting compound interest do the heavy lifting over decades. But distribution is a highly surgical operation. You have to navigate shifting tax brackets, delayed Medicare surcharges, market sequencing risks, and estate transfer laws, all while safely extracting a cash flow that needs to last for decades. It requires intense, proactive preparation.
30 years is a staggering amount of time to plan for. If an executive retires today at age 60, a 30-year planning horizon takes them to 90. That is longer than many people's entire professional careers.
Which is wild to think about.
It is. The architecture you build today has to survive future inflation spikes, multiple severe recessions, changes in family dynamics, and congressional tax regimes that haven't even been written yet. It demands a level of structural sophistication that simply isn't required when you are just saving money.
Which leaves me thinking about the very foundation of those 30-year projections. Because everything we've explored today, from intentional bracket filling to dodging 2-year IRMA landmines to the 10-year rule for heirs, it's all entirely predicated on current actuarial tables and expected lifespans.
True.
But I want to throw a wrench in the gears for you as we wrap up. If our entire tax landscape requires this intricate, delayed reaction planning based on a 30-year timeline, imagine how the math shatters if human lifespans suddenly leap forward.
Oh, wow.
With rapid advances in biotechnology and cellular regeneration, what if living to 100 or 110 becomes the standard baseline? Are our current dynamic withdrawal rates and cascading bucket strategies actually conservative enough for a future where a 30-year retirement suddenly morphs into a 50-year retirement? Just how massive does that long-term growth bucket need to be if the descent down the mountain takes half a century?
That is a profound structural question. If the biological horizon shifts that drastically, Every single Monte Carlo simulation and distribution model we rely on today might require a fundamental rewrite.
Something to mull over.
Yeah.
Until next time, make sure your climbing gear is packed away safely and keep a very close eye on your descent.